Hey, Internet. Welcome back to another episode of New Foundations, a podcast brought to you by Acropolis, the Bitcoin Treasury company. For episode number 10, I'm here by myself. We've had a lot of amazing guests from Eric Semler of Semler Scientific to Ben Justman of Peony Lane Wine to CJ of MicroStrategy and several others. But today we're going to focus on Acropolis. I'm going to read through our white paper if you haven't had the chance to do so already and talk about what we do and how we see the world. So, without further ado, let's go ahead and get into it. Acropolis, the Treasury solution for the Bitcoin age. We believe that every business will hold Bitcoin, and Acropolis is pulling this future into the present. Bitcoin is the ideal Treasury reserve asset due to its unique store of value properties, and implementing Bitcoin into a Treasury strategy is the consummate way to strengthen a company of any size. Currently, few businesses have developed the necessary conviction and alignment to hold Bitcoin. However, more recently, the corporate adoption of Bitcoin has accelerated. This comes at a time when U.S. Treasuries, the long-standing global reserve asset, are coming into question as the de facto solution. A Bitcoin purchased or earned today will be worth more in the future. The appreciating value of Bitcoin will drive increased enterprise value. It will become clear to all in the future, however, the early adopters will gain most. Outperforming Bitcoin through traditional business activities will be exceedingly challenging. As healthy behavior or means of survival, companies will need to integrate Bitcoin into treasury management, strategic investments, and service offerings. Acropolis is building the comprehensive Bitcoin solution for businesses to thrive during this age of perpetual monetary debasement and disruptive technological advancement. At Acropolis and Early Riders, our Bitcoin thesis is rooted in deep conviction that Bitcoin is a transformative force reshaping the future of finance and business. Bitcoin has been the best performing asset class since 2011. Adoption metrics are accelerating, and the recent success of the ETFs showcases a demand from traditional finance. That said, we are still early in the potential valuation of Bitcoin, and most have yet to take advantage of Bitcoin's unique properties as both a store of value and technology layer. Embracing the decentralized and deflationary nature of Bitcoin will continue to reward early adopters. As central banks are forced to debase their fiat currencies, many will need to seek refuge in an immutable form of money that operates on a decentralized network. Bitcoin is a superior store of value, medium of exchange, and unit of account that represents an escape valve for individuals and businesses alike. However, understanding the positive monetary impacts of Bitcoin often unfolds for someone throughout a full Bitcoin cycle, as participants witness Bitcoin's resilience and its longer-term trajectory. These observations lead to an evolution in the perception of Bitcoin from a speculative asset to a reliable store of wealth, medium of exchange, and unit of account. For many, this then develops into the recognition of Bitcoin as the most rational hurdle rate for evaluating investment opportunities due to its consistent monetary policy and upside valuation potential. Businesses of all maturity levels require Bitcoin to address the challenge of preserving excess productivity and energy. Conventional methods such as share buybacks, short-term cash holdings, or dividends only scratch the surface and don't offer a solution to the debasement issue faced by businesses. Taking on debt is an alternative, but it comes with significant drawbacks and endless covenants, with the potential to trigger insolvency. Bitcoin is the superior store of value, and it will usher in a new era of entrepreneurship, benefiting both legacy and emerging technology businesses. Bitcoin has exhibited a remarkable risk-reward profile over the course of its existence, particularly when compared to traditional assets like stocks, bonds, or even commodities. Many corporate treasuries tend to prioritize supposed stability and reliability in their balance sheets, opting for assets like cash, bonds, or even gold. In reality, these assets are much riskier over longer time periods and thus pose a threat to the financial well-being of all businesses. The asymmetry in risk-reward between Bitcoin and traditional assets presents an opportunity for early adopters and career risk for those who ignore it. Finally, we are still in the early stages of building on Bitcoin as a technological layer. Currently, many businesses built on Bitcoin are merely replicating Web 2 companies. This stage can be likened to the internet in the 90s, with true innovation only beginning to emerge. We expect Bitcoin to follow a similar evolutionary path as the internet, expanding beyond asset speculation into specific use cases and widespread commercial adoption by all companies. There will be billion-dollar businesses built on market gaps for services and explosive new products that incorporate Bitcoin's utility. Many of these opportunities will be uncovered by builders at existing organizations as they implement Bitcoin solutions. We expect massive value to be unlocked as Bitcoin becomes a foundational monetary network and settlement layer, catalyzing a new wave of groundbreaking advancements across many industries. The structural design of the fiat monetary system places a significant burden on small and mid-market businesses. As sovereign debt levels in the global money supply trend toward exponential growth, the challenges these businesses face will continue to grow in nature and size. The traditional system bleeds the value of monetary savings, forcing society to use the financial system as the de facto and thoughtless saving vehicle. This provides an unnatural advantage to corporations that can access new capital via public markets. Additionally, a large share of newly issued money is invested into the stock market. When coupled with an eroding denominator, fiat, this ensures ever-increasing stock prices over the long term, further encouraging thoughtless investment into mega corporations. The larger a corporation becomes, the more financeable they are. This dynamic feeds on itself. Access to lower interest rates is yet another reason small and mid-market businesses are being eaten alive by corporations, which continue to improve their economies of scale. Stock buyback strategies are not deployed by private businesses. It's not uncommon for a small or mid-market business to hold its treasury exclusively in cash. Assuming annual money supply growth of 7%, holding $5 million in cash costs a small business $350,000 in purchasing power per year. If that business has an average salary of $70,000, this equates to the productive capacity of 5 full-time workers being stolen from the business via inflation every year. When viewed through this lens, it becomes clear that a Bitcoin treasury strategy is the only realistic path for a small and mid-market business to continue competing for decades into the future. When a business acquires Bitcoin the asset, it's connecting its balance sheet to Bitcoin the network, laying the groundwork for a strong foundation. Forward-looking business owners and operators have realized Bitcoin for what it is, long-term oriented capital that is verifiably scarce and free from debasement. In the coming decades of monetary debasement and technological disruption, there will be a high correlation between the entities that survive and the entities that adopt Bitcoin ahead of their peers. This strategy is the best path forward for small and mid-market businesses. It enables the freedom to operate and grow without the burdens of the traditional systems, which are not built for small or mid-market success. Although the structural design of the fiat monetary system provides inherent benefits to large corporations, these entities face a different set of challenges in order to survive and thrive. The monetary policy forces corporations out of cash and applies urgent pressure to use retained earnings to create shareholder value. Assuming annual money supply growth of 7%, holding $1 billion in cash costs a corporation $70 million in purchasing power per year. This destroys a more natural desire to accumulate long-term capital due to limited options of successfully storing and preserving value. Assets needed for liquidity are typically held in treasury bills and money market instruments. This is preferable to holding cash as it generates a return while simultaneously avoiding volatility. However, these securities are not tax-deferred, and the associated yields fall well short of the true cost of capital. Regulatory considerations inhibit a corporation from storing its treasury in a stock index fund as an attempt to keep pace with the rate of currency debasement. If over 40% of assets are held in securities, excluding sovereign debt and cash-related instruments, the corporation is deemed an investment company, losing the ability to issue debt and stock options. Hypothetically, if corporations could store the majority of their treasuries in the S&P 500, investors would view this as a conventional strategy that can be deployed independently without exposing oneself to equity risks of the individual corporation. This dynamic has resulted in a standard treasury playbook centered around stock buybacks and acquisitions. If the goal is stock price appreciation in the short term, using retained earnings to buy back stock works tremendously well to enrich investors and executives. This comes at the detriment of the long-term health of the business. Successful buybacks typically lead large corporations to issue debt in order to continue the buybacks. Healthy corporations become highly levered and therefore fragile in order to keep pace with the returns of competitors employing this strategy. It's gone so far as to be viewed as dilutive to shareholders if the strategy of buybacks is not deployed. By decapitalizing the business in order to prioritize short-term stock price, corporations are not prepared for a series of underperforming quarters, let alone a disruption like COVID-19. Additional drawbacks exist for the standard Treasury playbook of stock buybacks and acquisitions. For the majority of businesses, giving back the financial capital to investors via buybacks will eventually lead to the loss of human capital because it will struggle to compensate elite talent with stock options that no longer possess the potential for upward volatility. In regards to acquisitions, the Harvard Business Review estimates that 70 to 90% fail due to integration challenges, cultural disruption, unclear strategies, among other factors. Failed acquisitions, driven by a desperation to support stock prices, are the most common reason why previously successful software businesses fail. What about commodities? Prior to Bitcoin, there wasn't an option for a financial commodity that is fungible and liquid that can be held on the balance sheet. Historically, the financial return of a commodity had to overcome the natural market incentive to drive the price of that asset down by finding and producing more of it. Although Bitcoin miners are incentivized to produce more Bitcoin, the amount and pace at which this can be done is programmatically fixed. For a public company to deploy a Bitcoin treasury strategy, this requires alignment across the management team, general counsel, board of directors, and the outside auditor and counsel. If alignment can be achieved across the different stakeholders, public companies can be very powerful vehicles to maximize the opportunity of acquiring Bitcoin during its monetization phase. Leveraging all facets of the capital markets can be utilized to increase Bitcoin per share, a new phenomenon introduced by MicroStrategy that is starting to be copied at an accelerating rate. Traditionally, for the thousands of publicly traded companies, volatility of both the balance sheet and the income statement is something to be managed away and limited in severity. Bitcoin represents a paradigm shift to treasury strategy that will continue to reward corporations with the foresight and low time preference required to benefit. The Financial Accounting Standards Board, FASB, provides accounting guidance and standards for businesses that comply with generally accepted accounting principles, GAAP. In September of 2023, FASB voted unanimously to transition Bitcoin to the fair value accounting method. The value of Bitcoin holdings will now be adjusted to the current market price at quarter end. The corresponding change to the unrealized investment gain or loss will pass through to the income statement. This new standard is optional for 2024 and mandatory starting in 2025. In regard to corporate Bitcoin adoption, the significance of this accounting change cannot be overstated. Until this new standard, Bitcoin was considered an indefinite intangible asset for accounting purposes. Other assets with this classification include patents, trademarks, and goodwill, brand value. Under this treatment, if the market value of Bitcoin decreased, the unrealized loss was recognized as an impairment to the balance sheet. A corresponding impairment charge impacted the income statement within the core operating expense section, with the potential to make a profitable business appear to be unprofitable. This adjustment was made in a negative-only fashion, as company balance sheets were not permitted to reflect an increase in the value of Bitcoin, nor recognize the unrealized investment gain on the income statement. Essentially, Bitcoin holdings were fixed at the lowest valuation possible since it had been acquired. Prior to the updated standard, the vast majority of public company executives would have seen the accounting treatment as a non-starter for Bitcoin adoption if they had even gotten that far. The intangible asset classification would obscure the financial statements and strip the useful information out of the all-important EPS. The negative-only treatment had the potential to unnecessarily impact credit ratings. A potential investor would need to reconstruct their entire view of a business, spending hours instead of minutes to evaluate financial performance. This treatment was very inappropriate for a liquid asset, let alone an asset that trades 24/7 across the globe with a transparent and indisputable market price. Fair value accounting removes a major impediment to Bitcoin adoption. Now the unrealized gain or loss from investment activity in Bitcoin will pass through to the income statement and appear below the operating activity in the other income and expense section. This allows for a quick assessment of 1, how the core operating business is performing, and 2, how the decision to accumulate Bitcoin is performing quarter over quarter and year over year. On the financial statements of companies holding Bitcoin, the footnotes will no longer need to convince the audience that its financial picture is more attractive than it appears. The pathway has now been cleared for all businesses to adopt Bitcoin as a reserve asset. As Bitcoin continues to eat value away from other asset classes, Bitcoin as the premier treasury asset is a story that will sell itself. Previously, due to the accounting risks and communication challenges, it would have been legitimate for public company CEOs and CFOs to ask, why would we, in regard to holding Bitcoin? In the not too distant future, CEOs and CFOs operating in the fair value accounting environment will have to answer the question, why aren't you? Bitcoin is not only a transformational asset, but a transformational technology and global settlement layer. As Bitcoin gradually becomes the base layer of economic activity, the products and services best positioned to play a foundational role in this new paradigm will be built from the ground up and leverage all of Bitcoin's native properties. Acropolis is building the first comprehensive solution for the future of treasury management. Our offering is built on 3 pillars. Number 1, custody. Number 2, advisory. And number 3, ancillary services. OnRamp, an early riders portfolio company, pioneered the breakthrough approach of multi-institution custody, MIC. This represented a step function improvement over traditional custodial models in the Bitcoin space and a logical evolution of custodial standards as Bitcoin scales to the masses. MIC leverages the emergent properties of the Bitcoin protocol, namely multisig, to distribute counterparty risk and eliminate single points of failure. OnRamp's MIC plays a foundational role in the comprehensive Acropolis solution. As Bitcoin adoption gradually spreads to every company, institutions will need to play a critical role in safely storing the asset. There is now a way to do so in a trust-minimized fashion that honors the distributed ethos of the protocol and upholds the interest of end users. The power of this model is twofold. Mitigate single third-party points of failure and reduce your own personal attack surface/technical burden, both of which have historically plagued the industry. OnRamp's MIC solution solves this by leveraging a 2f3 multisig multi-signature quorum to secure users' Bitcoin. In this arrangement, 3 separate institutional entities, OnRamp, BitGo, and CoinCover, each hold 1 private key, and any 2 of these 3 keys are required to effect the movement of funds. The game theory underpinning the 2 of 3 multisig quorum further strengthens the system against potential threats, providing a robust and redundant solution for end users. Unlike collaborative custody models, the end user does not need to hold any keys. Instead, 3 institutions work together to manage private keys and facilitate transactions, all while avoiding unilateral control. End users can always audit their funds on-chain and withdraw assets in kind if they choose. Prior to MIC, an entity had to choose between trusting a centralized custodian or holding its own private keys, which creates numerous headaches across the critical business functions of regulatory, audit, corporate governance, and business continuity. Bitcoin Strategy Officer, a new role that will continue to grow in importance and necessity. There is a significant shortage of hireable talent for businesses of all sizes to fulfill the role of Bitcoin Strategy Officer. Acropolis closes this gap by allowing companies to outsource this critical function. This eliminates the pain point of number 1, enterprises hiring unqualified individuals due to a lack of options, and number 2, small and mid-market companies prematurely hiring full-time resources. The financial position of individual companies varies greatly, whether based on size, age, industry, cyclicality, or level of success. Likewise, the appropriate Bitcoin accumulation strategy will vary greatly from business to business. We live during a time in society where nuance is often missing from the conversation, and at times, this enters Bitcoin-related discourse. Reality is that a great degree of personal preference is involved in determining a Bitcoin accumulation strategy, and many different factors and probabilities must be weighed. Acropolis is not in the business of making specific buy-sell recommendations, and Acropolis does not make decisions on behalf of companies. Rather, we arm decision makers with the relevant education and historical information needed to create an appropriate and sustainable accumulation plan. The Acropolis Bitcoin Treasury Playbook is an open-source, high-level guide for entities of all sizes that look to fortify its balance sheet and strengthen its future outlook. The accumulation strategies covered in the playbook include a one-time buy and hold, dollar cost averaging, periodic purchases, and utilization of capital markets. The Acropolis Bitcoin Treasury Playbook is a starting point for businesses to consider accumulation strategies, purchasing, custody, insurance, accounting, and a Treasury reserve policy. The Treasury function of a business serves the critical role of managing financial resources and risks. Successful management of a Treasury is twofold. Number one, manage the day-to-day operations and obligations. Number two, develop and execute the long-term financial strategy. It's critical to not cause a major disruption to one or both of these necessary functions when integrating Bitcoin into a treasury strategy. This is top of mind in the design of the comprehensive Acropolis solution. Accounts will have access to fundamental Bitcoin functionality to facilitate treasury operations. Buy and sell, deposit and withdraw, and month-end reporting. The ongoing development of the Acropolis solution will cover all facets of the treasury function, from payments integration, cross-border payments, remittances, e-commerce integration, point-of-sale integration, bookkeeping, bank integration, forecasting, payroll, accounts payable and receivable, rewards, and escrow. Bitcoin's transformative properties will disrupt the traditional treasury function in ways that cannot be fully known at present. Acropolis is building the comprehensive solution to maximize this new frontier. Now for a scenario analysis. The following analysis is for illustrative purposes and relies on hypothetical results. The impact of the consistent accumulation of Bitcoin can be seen over the course of years as opposed to weeks or months. In order to show the potential results of acquiring and holding the asset over a 5-year period, we need to use historical results to assume potential price scenarios of Bitcoin. The following projections show the cumulative impact of two different businesses accumulating Bitcoin on a monthly basis, incorporating the potential base case and bull case price paths. Accumulation starts on September 1st, 2024 for both entities. Monthly Bitcoin price follows a linear path between assumed peaks and bottoms, as opposed to guessing the exponential timing in both directions. Costs associated with acquisition or custody are not reflected in the numbers. Start with business number one, an initial purchase of $300,000 and monthly purchases of $15,000. In our base case, at the end of year 5, business number one will have accumulated 10.64 Bitcoin for a total cost of $1.2 million. The market value of that Bitcoin will be $3.5 million for a total ROI of 188%. In the bull case, at the end of year 5, business number one will have accumulated 6.31 Bitcoin for a total cost of $1.2 million. The market price of Bitcoin at the end of year 5, then, for the bull case, will be $4.4 million for a total ROI of 268%. Now, if you compare this to T-bills or money market funds, they would only see an ROI over that same period of 11%, leaving business number one with $1.3 million from $1.2 million in total invested capital. Now for business number two, with an initial purchase of $1 million and monthly purchases of $50,000. In our base case, at the end of year 5, business number two will have acquired 35.477 Bitcoin for a total cost of $4 million. The market value of that Bitcoin will be $11.5 million for a total ROI of 188%. Now, in our bull case for business number two, at the end of year 5, they will have acquired 21.02 Bitcoin for a total cost of $4 million. At the end of year 5, in our bull case, that value will be $14.7 million for a total ROI of 268%. Now, to compare this with T-bills yet again, you would only have $4.4 million at the end of year 5 for a total ROI of 11%. Given the disclosed assumptions, the businesses experience a tremendous ROI and result from the 5-year accumulation and hold of Bitcoin in its treasury. The higher prices of the bull case lead to the business being able to accumulate less Bitcoin, but they end up with a higher ending value and ROI due to the higher value of each Bitcoin that they were able to accumulate. If any of this piqued your interest, we have an amazing team at Acropolis ready to help your business acquire, custody, and use Bitcoin. So don't hesitate to book a consultation with us at acropolistreasury.com/book. If you want to dig deeper into the white paper that I just went over, go to acropolistreasury.com/whitepaper. You can check it out there. That's all I have for this episode. I hope you enjoyed. I hope it was helpful. And we'll be back next week with another guest and traditional episode of New Foundations. See y'all later. Thanks for listening to this week's episode of the show. Quick reminder that New Foundations is for informational and entertainment purposes only, and nothing should be construed as investment, financial, or legal advice. Business owners, business operators, and those who are Bitcoin curious, let's connect. Visit acropolistreasury.com to learn more or to get in touch with our team.